Hello, in this lecture we're going to work some smaller test type problems that could be small enough to fit into a multiple choice type format. So first we have here, company allocates overhead to production on the basis of direct labor hours. At the beginning of the year, company estimated total overhead of $345,600, materials of $406,000, and direct labor of $216,000. During the year, company incurred $414,000 in material costs, $412,800 in overhead costs, and $220,000 in direct labor costs. Compute the amount of overhead applied to jobs during the year. So what we have to do to understand this is the idea that we're going to come up with a predetermined overhead rate so that we can apply the overhead to the jobs as the jobs are going. So what we do that, in order to do that, we're going to use the numbers before the period, at the beginning of the period in this case, in order to come up with that rate, and then use that in order to apply the overhead based on the direct labor. So at the beginning of the year, the company estimated overhead to be, so we're going to say overhead, we think it's going to be at the beginning of the year $145,600. We're just estimated. Overhead, all that stuff, you just put in the bucket. We don't know which job to apply it out to. And we think that the direct labor is going to be at $216,000. And direct labor has nothing to do with the overhead, but we're going to use the direct labor in order to come up with our rate to apply to the overhead. So what we're going to say is this: if there's going to be $345,600 in total overhead divided by the $216,000, then I'm going to go to the Home tab, Numbers, increase the decimals. So that's 160, or we could represent it in terms of a percent, which would be 160%. Now, real quick, why would we do that? Because the direct labor here is going to determine how large the job is. The more direct labor goes into a job, the bigger the job is, and therefore the more overhead we need to apply to it. That's why we're using the direct labor to allocate the overhead, because we don't know how much overhead to allocate to a job because all jobs are different, and we can't just allocate an even amount of overhead for that reason. So now that we have our number, then we just need to figure out what the direct labor was during the year. And they give us all this other information we don't need to know. During the year, the incurred materials of this, we don't care. Overhead of this, that you would think that would be important because that's the overhead incurred during the year. But what we're doing is trying to find out the estimated overhead to apply during the year. So what we're going to look for is the direct labor in the year. And actually, this is the direct labor, the $220,000 direct labor, not the overhead costs. So we're going to take that, multiply the 160 times the 220, and we come up with the 352. That's 1,000. That's the amount of overhead that we are going to apply out, even though the overhead in the actual that we actually incurred is actually greater, 412,800. And that's because the number we came up with, of course, is an estimate at the beginning of the year, and we're going to have to reconcile that to the actual that actually happened throughout the year. Next one says, company uses a job order costing system. During 1 month, company purchased 214,800 raw materials on credit. Issued materials to production of 209,000, of which 34,200 were indirect. Company incurred factory payroll of 158,400, paid cash, of which 44,200 was indirect labor. Company uses a predetermined overhead rate of 150% of direct labor cost. Company beginning and ending work in process are 16.9 and 29.8 respectively. Compute the cost of production transferred to finished goods inventory. Alright, so that's a lot to take in there. What we're trying to do here is figure out how much should be transferred to ending inventory. If it's going to ending inventory, it's leaving the work in process account. So that's what I'm going to focus in here. We could do this in T account formation, or we could do it in kind of a chart or a calculation. I'm going to take a look at the T account because I think that's more of a visual look at it. So I'm going to take work in process, the WIP account, work in process. I'm going to merge that here. I'm going to underline it there and make our T like so and put on the left-hand side like this. All right, so this is what we have. And when we look at the work in process account, we're going to start with the beginning balance. And the beginning balance they said down here in the work in process was 16.9. That's what it started off with. It's an asset. It's an inventory account. 16.9 is what we start off with. What we're trying to get to is the amount that got transferred out. So we're going to have to see the activity during the period and then subtract it from the ending balance. Now, what is included in work in process? Well, work in process includes the direct materials. It includes the direct labor. And it includes the factory overhead. So I'm just going to call those are the things we're looking for. Once we get those things, then we know that we have an ending balance here, and they already gave us that. So the ending balance is going to be this 29, and I'm going to make it a credit, or actually it's going to be a debit over here. It's going to be the 29,800. That's where we're going to end up. We can put a line under that if we want. We can say that's going to be our ending balance. So now let's see what else they gave us here. So they gave us, if we look at it in terms of a table, we have direct materials and direct labor that we can take a look at. So we purchased 214,800. That really doesn't concern us right now because they told us the amount that got issued to work in process. That's where we're starting here. So we issued materials to production of 209. That's what we're starting here. That's what we're going to get into our work in process account. But of the 209, they say that 34.2 was overhead. So the overhead amount of it is 34,200. Therefore, the direct materials, I'm going to go ahead and underline that. Home tab, font group, underline, is going to be the 209 that got issued minus the 34,200. This is the amount that we know how to apply to the job. Therefore, it's going to go into our work in process. And so we know that's going to be one of our numbers that are going to go into the work in process for the asset. And then I'm going to go ahead and center this as well and underline that. All right, we may even want to bold it like that. Okay, so next thing we have is payroll of 158.4. And then it says that of that, 44,200 was indirect. So that's not direct. We can't apply 44,200 directly to a job. Therefore, I'm going to underline that. We're going to subtract that out. So that means the 158.4 total payroll minus the 44,200 we cannot apply to a job means that the 114,200 is the amount that we can apply to the job. And there we have that. And now we're looking for the overhead. And it's very tempting for us to say the overhead is this plus that. That's what actually was incurred during the year. But remember that we use the predetermined overhead rate to estimate what the overhead should go to. And it's hard to see in this picture because we're not looking at the jobs. The problem is I can't apply this to the jobs. That's the whole reason it's in the overhead. We're going to use the labor in order to help us apply it to the jobs. We're not going to apply them to the jobs in this problem, but that's the conceptual reason why we cannot just take the actual overhead and dump it into work in process, because work in process needs to be backed up by job. So we're going to be able to apply it by job by allocating based on 1.5 predetermined overhead rate. Home tab, font group, add decimals, or make it a percent. Then I'm going to underline that. And that means that the amount that we can apply to a job is the 114.2 times the 150%. That's our overhead that gets applied. Something like that. Okay, and then that's going to equal the 171.3. Okay, so there's what we have there. Now, I'm going to scroll down just a bit, and I'm going to add another row, insert a row, shift down. Okay. I don't know if that disturbed too many things, but then, I mean, if we add this up, we have the sum now. Whoop. This equals the sum of these. This is what we have in there. And we know that the ending inventory is this. So what we need then, I'm going to go ahead and underline that. That's what we have. This is where we need to get. The difference between those two numbers is then what we transferred out. That's what's going to leave the work in process. So it's going to be the 477.2 minus the 29.8. That's what's going to be transferred out. I'm going to represent it with a credit by putting a negative in brackets around it. And so you could check that. You could say, you could say this minus this is the 29,800. That means that this is the amount that got transferred out of the work in process in order to go to the finished goods. And if you wanted to calculate it with a table or something like that, you'd have to take, the beginning work in process, 169,000 plus the direct labor plus the direct material plus the overhead we had minus the ending balance. This is how it would basically be shown in like an answer key or something, of a type of problem like this. But notice it's could be easier in many ways to see it in terms of a T account because of the visual representation of it. Next one says, company applies overhead based on the direct labor cost. Estimated overhead and direct labor costs for the year were $119,500 and $125,700 respectively. During the year, actual overhead was $108,100 and actual direct labor cost was $114,500. The entry to close the over-under applied overhead of the year, assuming an immaterial amount, would include what? Okay, so this time we're looking at the overhead. So I'm going to say overhead and focus in on that as our T account so we can see the visual of the T account here. So I'm going to underline that. Going to put our T here. So we'll put that left-hand side, left border. There is our T at this time. Now, the company applies overhead based on direct labor cost. Estimated overhead direct labor costs are going to be 119. So I'm going to say 119,500 is our rate. And we had the 125 of direct, I'm sorry, the 119,500 is the overhead at the beginning of the year. So that's what we're going to use in order to estimate what will happen during the year. And then we had 125,700 of direct labor. So this is overhead, direct labor. We're going to use this to determine our rate. So I'm going to underline this. We're going to say, all right, well, if there's 119,500 estimated overhead divided by the estimated direct labor, 125,700, it's going to go to the home tab, number, and add, we're going to use 95%, 0.95 or percent, 95% to allocate the overhead. Meaning we're going to use the direct labor that will actually happen during the time period at a rate of 95% in order to allocate the overhead to jobs, the jobs being different in size, the reason we need to allocate using the direct labor. So then it says, during the year, actual overhead was 108. So if we look at the overhead T account, the actual overhead was 108, 100. That's what actually happened. That includes like depreciation on the factory, anything that says factory, utilities on the factory, you know, indirect labor on the factory, anything on the factory or any process that we cannot apply to the job directly goes into there. And then we're going to use this number to allocate the amount that actually happened based on direct labor. So direct labor was 114,500. So I'm going to go ahead and underline that. So then we're going to say that this equals the 95% rate times the direct labor 114,500. This is the amount that we can actually apply to the job. So that's the amount that's going to go out of, I'm going to make it a credit, it's going to go out of the overhead and apply it to the job. And notice that it's only an estimate, of course, and therefore it's not exact. This estimate doesn't equal what actually happened. This number is bigger than this number. If I see how much bigger, it's going to be equal to the sum of this, because it's going to be this number minus this number. We've got a 752 credit balance at this time. Now, when we start the next period, we don't want a 752 balance in there. We want that to be 0 so we can estimate what's going to happen next time. So what does that mean we have to do? We have to make an adjustment at the end of the period, which is going to be a debit to 752. And that will, of course, do what to the T account? It's going to make this go down to 0, which is what we want to happen so that we can make a new estimate. So what's the adjusting entry going to be? In this case, it's a debit to the overhead. A debit of 752 to get it to go to 0, and then we're going to just dump it somewhere. We're going to dump it into cost of goods sold. Usually we dump it into cost of goods sold. Why? Because hopefully it's in material, and cost of goods sold is related to, it's the income statement account related to inventory, and so if it's small, it's not going to affect cost of goods sold. Notice cost of goods sold is a expense account. This is a credit, so we're actually doing the cost of goods sold is actually going down and expense accounts going down. Doesn't normally happen. This is a rare exception to make an expense account go down. But the idea is it's in material and it will close out to retained earnings next time. So we won't have to worry about it again. It'll just kind of go away once it's closed out, and then we can start over with our new estimate with a clean slate.